Hello and welcome to episode 3 of Weapons of Mass Construction. I'm Bob Teska, partner in charge of construction services at Bowers Company CPAs. Today I'm going to present part 2 of 2 on a series related to the new revenue recognition standard. Just a quick summary. Topic 606, the new revenue recognition standard, will replace all industry and transactional specific guidance related to recognizing revenue. The purpose was to create one standard so there would be comparability for investors that were evaluating companies in different industries. If you didn't catch part 1, you might want to back up and log into part 1 and take a look at that. But with that, we're going to go ahead and get started with part 2 here. All right, so just a quick overview. This is the 5-step model that was introduced as the new revenue recognition standard. So we're going to identify the contract, which we did discuss on how you do that in episode 1, where it's got the criteria that need to meet the contract, where a party knows what's being given and received. There's probability that funds are going to be collected, etc. It also talks about how you would handle contract modifications, also known as change orders. And then we're going to identify the contract's separate performance obligations. We also talked about that in episode 1, and that was if you have separate deliverables within the contract. The example that we used a lot in there was you were hired to build or renovate a school pool and also a track and field facility. In one contract, you could deliver that separately, so those would be separate performance obligations within one contract. They have separate utility to the customer. So step 3 is where we're going to start today. We're going to determine the transaction price. And step 3 is probably got the most hair on it, or the most technical. Step 4, we allocate the transaction price, which was determined in step 3, to the separate performance obligations that were determined in step 2. And then once we've done that, we can recognize revenue. Fair warning on this, it's pretty technical. This is actually an easier presentation to do in person because I can field questions as it's being given. So I'm going to go through this, and then you're probably going to have questions. My contact information is at the end, and it's probably some other places within here. But feel free to reach out with questions via email, phone calls. I'd be glad to assist where I can. So moving on here. So determining the transaction price, really, what do you expect to be paid? And so one of the biggest changes in the way we're going to recognize revenue in this new world we're entering into here is you need to adjust the contract value for what you actually expect to be paid. So we're going to start with the contract face value. It's a $1 million contract, and we're going to plus or minus variable consideration. That's going to include unapproved change orders, performance bonuses, liquidated damages, and a host of other things. And we're going to go through a lot of examples on that, so I'm going to stop talking about that piece. We're going to plus or minus any non-cash consideration at fair market value. This isn't something you see too much in the construction world, but if you were going to be paid in something other than cash, like perhaps you were going to construct a building on one site in exchange for a piece of land at another site as part of your payment, that would be maybe non-cash consideration. Or if there was a significant financing component, again, this is something you don't see in the construction world too much, where you're going to do a task, but then not get paid anything for 18, 24 months. You might get strung out by a GC for a little bit, but that's really not considered a financing component. And then any consideration payable to the customer. If at any point you're going to have to give something back to the customer. The only place I've seen this is if it was a job to demo a facility, and they weren't actually going to pay you to demo it. You were going to bid on the job, and you were going to essentially pay for the right to demo it because of the scrap that you were going to get out of it. That would be the subtraction there. So contract face value plus or minus variable consideration plus or minus any non-cash consideration plus or minus if there was a financing component minus anything payable to the customer. That's going to net down to the amount recorded on your WIP schedule. In some cases, this may not be the contract value. So that has some people up in arms, especially in the surety world, but you know, it's going to adjust here. And as I said in part one, the larger, more complex the construction operation is, the more you're going to see this affect people and affect the way they're recording contracts on their work in process schedule. You know, for your smaller subcontractor, you might not see a lot of change from what you've seen in the past. So we're going to go ahead and start talking about this variable consideration. And here's kind of a list of the different types of variable consideration that should be considered. And the one I think we're going to focus on the most, we're going to talk about liquidated damages, just because that's an example that a lot of people are familiar with. But so that would reduce the contract amount, as you'll see. But this could also be an addition to it, where you know, like performance bonuses. And there's examples of all this as we go through. So let's just start working through some of this. So contractors are going to need to estimate the amount of variable consideration to include in each contract at the outset. So this isn't something that you do at the end. This is something when you get that contract, you figure out how many performance obligations you are. The contractor is going to be responsible for estimating how much variable consideration plus or minus to consider in that contract. And you don't guess. There's two methods that you use. There's an expected value method. It's a probability weighted average, kind of like a sliding scale. And then there's a most likely amount method. This is binary. It's either yes or no. So you've got to apply one method consistently throughout the contract, and the method you select should be applied consistently to other similar contracts. You can't say, well, this is going to work out better. The most likely amount method is going to work out better for this contract, but a similar contract, it's going to work out better for this expected value method, so I'm going to use that. It really needs to be consistent. Within this variable consideration, there's constraints. So you can't just say, hey, there's a performance bonus of $1 million on this contract. I'm going to include that at the outset because I can now. There's a constraint that you place on that where you must make an estimate with a constraint that it's probable, you know, about 70 to 80% they say, that you're not going to have a revenue reversal. So what that means is, at the outset of a contract, if there's a performance bonus for, say, $1 million, if you finish in a certain amount of time, you can only record that performance bonus or start to include that in your revenue recognition if you're 70 to 80% certain that by the time you get to the end of the contract, you're not going to have to reverse that. And the idea there is it's supposed to stop the contractor from the abuse of over or underestimating variable consideration. Because the same can be said for liquidated damages. You know, if you don't include them on the front because, oh, I never have them, but you typically do, you know, you've got to consider that at the outset. Because, you know, remember, the overall idea from this new revenue recognition model is you're going to recognize revenue in amounts that you expect to receive throughout the life of the contract. So if it's likely that you're going to have liquidated damages in the contract, you should record that as essentially part of the contract to begin with and really decrease the revenue recognized over the life of the contract. Like I said, there's some examples we'll get into that will make this hopefully a little more understandable. So first example here, you've got a contract to construct a $10 million building. It's one performance obligation that's going to be satisfied over time, so that's going to be percentage of completion. You've got to complete it in 104 weeks. If you don't, there's $20,000 per day liquidated damages. Based on the past experiences, the contractor estimates the following. And so this is this probability that I was talking about. So you can see that he says, I estimate that I'm going to have 0 weeks of liquidated damages, and the probability of that is 50%. 4 weeks of liquidated damages, I estimate that at 5%, and you can see the math here, $20,000 a day times 28 days is 560. 5% chance that comes over to 28,000. And he does this all the way down so that, he's got 100% probability that he's allocated throughout here. And when you, the weighted average of that over here is, about $954,000. So remember, the constraint is you want to get to that 70 to 80% level where it's a constraint that, you're not going to have revenue recognition reversal. You don't want to over-record revenue and then have to back it off. So, we get up to the point where we're over 70% of a probability. So here we've got 50% plus 5%, 5% here, and so that's 60%. So we got to go down one more level where it's at 15%. So we've got a 75% probability. And when you do the math, and the weighted average of that 75% is $336,000. So at the inception of the contract, the transaction price is going to be the $10 million contract price, and in this case, minus our variable consideration, which, using the weighted probability of averages, is going to be $336,000. So the amount that's going to show up on your work in process schedule is going to be, $9,664,000. So I know you're probably looking at this and your head is spinning and you're like, Bob, this doesn't make sense. My contractor that does, $5-6 million a year is probably not going to be able to do this. How could you tell me I have to do this? Is typically the response I get from people. Just remember, I didn't create this. The CPA world did not create this. This was created for investor clarity. So if everyone's recognizing revenue the same way across different industries, you can compare companies across different industries. Do I expect a contractor that, isn't incredibly sophisticated, he's doing $4 or $5 million a year hanging sheetrock to be able to do this? Probably not, right? He probably doesn't have a internal CFO and a controller and an accounting staff to do something like this. So I would expect the CPAs of the world to kind of help them do this, and work through it. And it's going to be on a case-by-case basis, that's really all I can say about that. But I fully anticipate assisting my clients in this sort of calculation if need be. The larger, more complex ones that have more of an accounting department, I expect they're going to be able to do this. And, I might have to help them and show them a little bit. But, I think they're going to be able to do this. The smaller ones, I expect there's going to be more hand-holding, and we're going to work through this as they've got contracts on their work in process schedule. And, I've also said that I think that it's going to be a little difficult this year as we're implementing it. But I think, a year or two down the road, it's just going to be common practice, and it's not going to be, that big of a deal. It's just going to be like, okay, this is what we do. All right. So the most likely amount method example. So this is the binary, the yes-no situation. So in this situation, we've got a fixed contract for $9.664 million plus a performance incentive of $336,000 for timely completion. Again, it's one performance obligation. It requires substantial completion in 104 weeks. And then the contractor achieves his performance incentive 50% of the time on his contract. That's his historical track record. So because of that, at inception, no performance incentive is going to be recorded. He's going to put that contract on his work in process schedule at $9.664 million. When he is 81 weeks into the contract, he's about 80% complete. The contractor reevaluates the situation, and he's looking at it. He's like, all right, I'm still on track to finish on time. And he looks at his track record, his historicals, and he says, all right, when I'm 80% complete and I'm on track at that point, I've got a track record that 70% of the time I do end up finishing on time, and I do collect those performance incentives. Because of that, he satisfies that constraint that there won't be, it's probable that there isn't going to be a significant revenue reversal. So at that point, he's going to go ahead and record that performance incentive. So the transaction price is going to be, so that transaction price is going to be bumped up from $9.66 million to $10 million. And there'll be a cumulative catch-up because the contract had only been $9.6 million in the past. It's now $10 million. So there'll be kind of a bump in revenue to get it caught up. And he's going to recognize revenue for the rest of the contract based on the $10 million level. All right. So that's kind of how we would handle variable consideration. Now we need to allocate a transaction price. So transaction prices are going to be allocated based on the relative standalone selling price of each performance obligation. So this is only an issue if you have more than one performance obligation. Again, if you're just the sheetrock guy, you have one performance obligation, essentially you skip this step, right? There's nothing to allocate. Everything's allocated to the one performance obligations you have. But for those that have multiple performance obligations in the contract, they're going to need to allocate it. And there's three methods to use. It's an adjusted market assessment approach, an expected cost plus a margin approach, and a residual approach, which is used in incredibly limited situations. But the good news is, in almost every situation, a contractor is going to use a cost plus a margin approach. This really is going to follow the bid process. And then your variable consideration that we looked at previously, that's going to be allocated to the specific performance obligation that applies to. So if you are concerned about liquidated damages on the pool piece but not the track piece, you would allocate all the variable consideration to the pool piece and not the track piece. So an example of allocating it based on standalone selling prices. So if you end up with a contract that's $900,000 and it has two performance obligations, and obligation A and B, like I said, it could be the pool and the track, and then but it's one contract with two performance obligations, you would look at it on a standalone basis first, and you said, all right, if I was doing obligation A only, that would probably be $400,000, and if I was doing obligation B only, that would be $600,000. And so, if I was doing these separately, it would be about $1 million. However, because the obligations are in one contract, you don't have to, get things going twice. You're already there. Economies of scale and such. You bid them together, and it's only $900,000. What you do is you allocate the transaction price based on the standalone price. So 40% would go to obligation B, 60% to 40% to A, 60% to B. So of the $900,000, 40% of that's going to go to A and 60% to B. So 360, 540 gives us your $900,000. So that's how you would allocate the transaction price. You look at it on if you were doing these things separately. So we've come up with we've taken our contract value, we've considered variable consideration, we've allocated the transaction price. We're finally ready to recognize revenue. So for contractors, this is most likely going to be done over time, calculated either on inputs or outputs method, similar to the cost-to-cost that we've used in the past. So under the new standard, like I said, it's all about timing. So in this situation, it's $1 million contract with $100,000 of variable consideration. In this case, we're talking liquidated damages that the contractor estimated they would incur. So under old revenue rec, you wouldn't consider those $100,000 of LDs on the outset. So as the contract was signed, zero revenue, 25% done, we've got $250,000, 75% done, you're $750. At 90% done, you got $900,000 recognized. But as you go to finish that last 10%, you incur those liquidated damages, and so you really only end up with $900,000. So under the new revenue recognition, what they want you to do is they want you to consider what you're going to receive at the outset, and so that slows down your revenue recognition, so you're not over-recognizing revenue. So at 25%, you would put so you would consider the $100,000 up front, so your contract, your performance obligation would be $900,000. on your WIP schedule, and then you would recognize accordingly off of that $900,000. So at 25% complete, you would only recognize $225,000. So as you can see, you're $25,000 behind where you were. At 50% complete, you're only recognizing $450,000. And then when you're 90% complete, you're at $810,000. So you're $90,000 behind where you were. However, at 100% complete, you end up at the same place, and you don't have this back off of revenue where you've had in the past, where you didn't consider liquidated damages. So you start at the same place, and you end at the same place, but you've recognized revenue according to what you actually expect to receive. And then, the pushback that I always hear on this is, what contractor is going to say he's going to incur liquidated damages on the outset? No contractor expects to incur liquidated damages. And I totally get that. Like 100%, I get it. Every contract's going to be a home run. Every contract, I'm going to have margin growth on it, not a margin fade. Totally get it. However, when a CPA comes in at the end of the year and they're looking at this, they're going to say, okay, let's take a look at these contracts. Let's consider our variable consideration. And we're looking at liquidated damages. And he's like, no, the contractor says, I'm not going to incur any liquidated damages on any of these. And you say, okay. So then we start looking at his record. It's like, all right, you say you're not going to incur any liquidated damages on any of these contracts. However, when I look at your past record, you incur liquidated damages on 60% of the contracts that you incur. So it's hard for me to say, it's just not going to happen. And it's going to be the CPA's job to kind of make sure the contractor is in line with the new revenue recognition. And say, we're probably going to need to include some variable consideration here. And, it could be challenging at times, I'd imagine. But the end result is going to be a financial statement that follows the new standards that are out there. So some major differences. We've talked about collectibility. We've talked about performance obligations. We've talked a lot about variable consideration. So these ones in red are ones that we have not talked about. They're not nearly as in-depth, and so I want to go through some of these here. So under current GAAP, or actually at this point it's old GAAP, you may combine contracts under certain situations if they're negotiated as a package with an overall profit margin objective. In essence, were an agreement to do a single project, if they were closely interrelated, or if they were performed concurrently or continuously, you may combine them. Under the new Rev Rec, you must combine contracts when entered into at or near the same time with the same customer, and if one of the following exists. They were negotiated as a package with one single commercial objective. The amount paid on one contract is dependent on the performance of the other, or the goods and services promised in the contract are a single performance obligation. In those instances, you would have to combine the contracts. So here's just an example. Separate contracts with the same customer for engineering services and construction services that are issued only a month apart. So in essence, it could have been issued as a design build contract. So these contracts would be combined, and you'd see it as one number on the work in process schedule. Again, this goes back to the kind of touchy-feely thing. Judgment's going to be required, and you have to review all the facts and circumstances in each contract. A warranty. So this is interesting. So your typical one-year warranty for workmanship, that's really not going to rise to the level of a separate performance obligation. However, the longer the warranty, the greater the chance that you're going to have to break off a piece of the contract and show it as a separate performance obligation. A distinct service will normally lend the warranty to being a separate performance obligation. One of the best examples is you construct a highway or a section of highway, and then you have to maintain it for a period of years. In those situations, call it a $50 million contract to construct the highway and then also maintain it for a period of, say, 5-10 years, you are going to have to allocate part of that contract price to a separate performance warranty performance obligation. And that's going to hang out on your work in process schedule for as long as that warranty period is. Warranties, they provide assurances of performance, so X amount of efficiency of a generator typically aren't going to give rise to a separate performance obligation. Uninstalled materials. This is an interesting one. Currently, unless there's certain criteria that are met, uninstalled materials should not go into your percentage of completion calculation. They get hung up on the balance sheet. Under the new standard, you can recognize revenue equal to the cost of those uninstalled materials. So, an example here, we've got a transaction price of $4 million. There's materials, this HVAC system of $1.5 million with labor of $2 million. So total expected cost of $3.5 million. So gross margin of $500,000. At about 12.5%. At 12/31, we've incurred $500,000 of labor. So about 20 of labor and overhead. So about 25% of what's expected. And we've got that HVAC system on site, but it's uninstalled. So total cost to date is about $2 million. So under the current, or really, like I said, at this point, the old revenue recognition standard, the uninstalled materials would end up on the balance sheet, and the only cost you would consider in your percentage completion is this $500,000. So it'd be $500,000 over the $3.5 million. It's going to be 14% complete, and you're going to recognize 14.3% of revenue. So you've got a gross margin of $72,000 or 12.5%. And then, like I said, those uninstalled materials end up on the balance sheet. Under the new RevRec, you actually do two things. So you consider the percentage of completion of the labor and overhead separately from these uninstalled materials. So you would do the $500,000 over the $2 million, which is about 25%. So your 25% of your non-materials costs have been incurred. So you recognize revenue on that piece of $625,000, and then you recognize revenue of $1.5 million from the uninstalled materials. So you're going to have revenue of $2.125 million. Your costs are going to be the $500,000 of overhead, and then you're going to have costs equal to the revenue you're recognizing on the uninstalled materials here. So your gross profit is going to be $2.1 million minus these $2 million in costs. So your gross profit is only going to be $125,000 or 5.9%. So the only gross profit you're getting is on the labor and overhead piece of the cost that you've incurred. So 25% of the labor and overhead, 25% of the revenue associated with that. So 625 minus the 500. So it kind of skews the percentage of completion that we're normally used to. The overall job is going to have 12.5% margin. Currently, though, we're going to show 5.9% because we have these uninstalled materials. So that's something to watch out for. Uninstalled materials are going to be disclosed in the footnotes, so you'll be able to track them and kind of understand why it looks a little wonky. Retainage, it's no longer going to be considered a receivable, like an accounts receivable, but it's still going to be an asset. Really, an account receivable or receivable, it's the right to consideration based solely on the passage of time. But when you think about retainage, they're withholding payment to kind of force you to keep working on the job. So retainage is actually contingent on additional performance by a contractor / acceptance to the customer. So retainage while the job is in process is kind of going to be a separate line item or not part of receivables. When the job is complete, so you've got retainage on a completed contract, those retainages then are due to you solely on the passage of time, so they'll be part of your receivable balance then. So you're probably going to see receivables broken out, or retainage broken out separately, retainage on completed and in-process jobs. Tax implications. The IRS did issue a notice requesting comments from preparers, tax preparers, and then kind of after that it's been relatively silent. For C Corp, there's going to be a little more complexity when you're calculating deferred tax assets and liabilities. There is the possibility of having to kind of keep two different sets of percent complete calculations. However, The IRS has said there will be an automatic change using Form 3115 saying that you can elect that now my new book policy is the new Rev Rec, so I'm not going to have, if you did that, that would eliminate the need to have two percentage of completion calculations, but I would imagine most people are going to do. Billings in excess and costs in excess, you know, the guidance was calling this contract asset and contract liability. I think you might see it both ways on your balance sheet. You may see some people calling it contract asset and contract liability. I've also seen some companies that have issued statements already that are still calling it billings in excess and costs in excess. So you know, that's just a change of wording, so not a big deal there. Disclosure. There's going to be a significant increase in the amount of disclosures. Publicly traded companies, there's going to be pages and pages of it. For privately held companies, they have given us kind of a pared down version of what's going to have to be disclosed. But there's going to be qualitative and quantitative disclosures really in sufficient detail so the users of the financials understand the nature, timing, and uncertainty of revenue. You're going to have to disaggregate revenue in some way, either by, you know, just, it could be any way that makes sense. So it could be in geographic region, the type of contracts, if you're GCs and subs. I mean, you just have to break revenue out by some disaggregated way that makes sense to the users of the financials. And then you're going to have to disclose some of these other things about performance obligations and the variable considerations and the other things that we've talked about. There's going to be disclosures that go along with them, including that uninstalled materials. So there's going to be accounting policies on all of these issues here, warranties, your constraints, uninstalled materials, variable consideration. All of this is going to be disclosed in your financial. There's a couple of ways to transition into this. So the first is a full retrospective, meaning that, so if we're assuming you're a private company at 12/31/19, they can go back and totally restate 12/31/18, and there'd be a cumulative catch-up adjustment to retain earnings, essentially the beginning balance of, 12. So if you do it in 19, there'd be a cumulative catch-up of the 12/31 beginning balance of retained earnings. So that's kind of complicated, more complicated than I think our firm is going to do, where restating the prior year. So more than likely, we're going to use the modified retrospective. So 12/31/19 is going to be under new GAAP, and then there's going to be adjustment to beginning retained earnings. So the 1/1/19 retained earnings, there's going to be adjustment to that you disclose, saying essentially, you know, had we used the new revenue rec in 12/31/18 financial, the adjustment would have been this, and here's why. So full restatement or modified retrospective. Modified retrospective is a little bit simpler, still follows the new standards. So that's where our firm is heading, but you could see both ways. These are the sources I used for this presentation. Again, in case you want some additional reading, you can go ahead and check that out. And that's going to conclude this. Again, I know this was dense. It was incredibly technical. So please, if you have questions, feel free to reach out via email or phone. I'd be glad to help you in any way I can. And that is going to conclude episode 3 of Weapons of Mass Construction. Have a great day.